Hello friends, welcome back to Book Demystified once again, and today we're going to discuss about The Little Book of Common Sense Investing by John C. Bogle. Now, imagine if I told you that there's a guy who literally revolutionized how millions of Americans invest their money, saved them trillions of dollars in fees, and his approach is so simple that you could explain it to a 10-year-old in about 5 minutes. Sounds too good to be true, right? Well, that guy is John Bogle, the founder of Vanguard. And what he discovered will completely change how you think about building wealth. But here's what's absolutely mind-blowing. Most people are still doing the exact opposite of what he recommends, and it's costing them their financial future. You know what's happening right now across America? People are getting absolutely crushed by investment fees they don't even know they're paying. They're chasing after hot stock tips, trying to time the market, and basically gambling with their retirement money while thinking they're being smart investors. Meanwhile, there's this incredibly simple strategy that requires almost no effort, costs practically nothing, and historically beats about 90% of professional money managers. I'm talking about something so straightforward that it sounds boring, but boring might just be the secret to getting rich. And the crazy part is, while your friends are staying up late researching stocks, stressing about market crashes, and constantly checking their phones to see how their investments are doing, you could be building more wealth than all of them combined with a strategy that takes about 15 minutes to set up and maybe 5 minutes a year to maintain. The problem is, nobody wants to hear about the boring solution because we've been conditioned to think that investing has to be complicated, exciting, and requires some sort of special genius to succeed. But what if everything you've been told about investing is not just wrong, but actually designed to separate you from your money? Here's the thing that really gets me fired up about this topic. Every single day, hardworking Americans are getting ripped off by an investment industry that profits from making simple things seem complicated. You've got financial advisors charging you fees to pick mutual funds that charge you more fees to invest in stocks, and then those same mutual funds are constantly buying and selling, generating even more fees and taxes that come straight out of your returns. It's like going to a restaurant where they charge you a cover charge to get in, then charge you for the menu, then charge you for each bite of food, and then add a service fee on top of everything else. By the time you're done eating, you've paid 3 times what the meal was actually worth, and you're still hungry. Bogle figured out that this whole system is basically a giant scam, and he spent his entire career fighting against it. He didn't do this to get rich himself. In fact, he could have made way more money if he had just gone along with how everyone else was doing business. Instead, he created Vanguard as a mutual company owned by its investors, which means all the profits go back to the people who invest with them, not to some wealthy shareholders. When I first learned about Bogle's story, I was honestly pretty angry. I realized how much money I had wasted over the years paying unnecessary fees and trying to be clever with my investments. I was like most young Americans. I thought I needed to find the perfect mix of stocks, maybe throw in some international funds, add a little bit of this sector and that sector, rebalance everything quarterly, and constantly monitor my portfolio to make sure I was optimized for whatever the market was doing. I was spending hours every month researching funds, reading financial websites, and basically turning investing into a part-time job that I wasn't even getting paid for. And you know what? All that effort got me returns that were worse than if I had just put everything into a simple index fund and forgotten about it. That's when I discovered Bogle's fundamental insight, and it's so simple that it's almost insulting to our intelligence. Ready for it? Just buy the entire market and hold it forever. That's it. That's the secret that beats 90% of professional investors and requires virtually no skill, knowledge, or time. But wait, how can something so simple actually work? Well, Bogle explains it using what he calls the relentless rules of humble arithmetic, and once you understand these rules, you'll never look at investing the same way again. First, let's talk about what happens when you try to beat the market by picking individual stocks or actively managed mutual funds. Every time someone buys a stock, someone else has to sell it. Every time someone makes money on a trade, someone else loses money. Before any fees, taxes, or trading costs, the average return of all investors combined has to equal the market return. It's mathematically impossible for everyone to beat the average because everyone together is the average. Now here's where it gets interesting. Once you factor in fees, taxes, and trading costs, the average active investor has to earn less than the market return. It's not that active investors are stupid or unlucky, it's that they're playing a game where the odds are mathematically stacked against them. Think of it like this. Imagine there's a casino where the house edge is so small that you have a 49% chance of winning and the house has a 51% chance. That doesn't sound too bad, right? You might think you could overcome those odds with skill or luck. But in the investing world, the house edge from fees and costs is more like giving the house a 70% advantage. You're not just fighting other smart investors, you're also fighting a system designed to extract money from you at every turn.
Bogle's solution is to stop playing that rigged game entirely. Instead of trying to beat the market, just be the market. Buy a broad-based index fund that owns a tiny piece of every company in the stock market, and you're guaranteed to get the market return minus a tiny fee. No more, no less. This might not sound exciting, but let me put this in perspective for you. Over the past century, the U.S. stock market has returned about 10% per year on average. Some years it's up 30%, some years it's down 20%, but over long periods it averages out to around 10%. Now, if you're paying 2% per year in fees and expenses to actively managed funds, you're giving up 20% of your returns. Over a 40-year career, that difference between 8% and 10% annual returns is absolutely massive. Let's say you're 25 years old and you start investing $300 per month. If you earn 8% per year after fees, you'll have about $800,000 when you retire at 65. But if you earn 10% per year by avoiding those fees, you'll have over $1.9 million. That's more than double the money for doing less work and taking less risk. When I first ran these numbers for my own situation, I literally felt sick to my stomach. I realized that the fees I was paying were going to cost me hundreds of thousands of dollars over my lifetime. And for what? The privilege of having some fund manager try to beat the market when study after study shows that they failed to do so consistently? But here's what really opened my eyes to Bogle's genius. He didn't just create a better investment product, he created a better business model. Most investment companies make more money when they gather more assets and charge higher fees. They're incentivized to make investing seem complicated so they can justify their high costs. Vanguard, on the other hand, is structured so that lower costs for investors mean higher profits for the company, since the investors are the company. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI, the links below. Every bit of support helps us keep creating valuable content for you. Now, Bogle doesn't just tell you what to do. He explains exactly why his approach works by breaking down the components of investment returns. He shows that there are really only two sources of return in the stock market: the dividends that companies pay to shareholders and the growth in the underlying value of those companies. Over the long term, these two components have provided that 10% average annual return I mentioned earlier. Everything else, all the buying and selling, all the market timing, all the fancy strategies, is just noise that adds costs without adding value. This is where Bogle introduces one of his most powerful concepts: the difference between the investor's return and the investment's return. The investment might earn 10% per year, but the investor might only earn 6 or 7% because they're buying high when they feel optimistic and selling low when they panic. I see this happening constantly with people I know. During 2020, when the market was crashing because of COVID, everyone was terrified and wanted to sell their investments. Then, as the market recovered and reached new highs, those same people wanted to get back in because they felt like they were missing out. They were essentially buying expensive and selling cheap, which is the exact opposite of what you want to do. Bogle's index fund approach eliminates this problem because it removes emotion from the equation. You're not making decisions about when to buy or sell based on how you feel about the market. You're just steadily accumulating shares of the entire market regardless of what's happening in the short term. One of my favorite stories from the book is about Bogle's own experience during the 1970s, which was one of the worst decades for stocks in modern history. While most investors were panicking and abandoning the stock market, Bogle kept buying index funds month after month. Those purchases, made during one of the most pessimistic periods in market history, generated enormous returns as the market recovered in the 1980s and 1990s. This is the power of what Bogle calls staying the course. It's not glamorous, it's not exciting, and it doesn't make for good conversation at parties, but it works, and it works better than almost any other strategy you can implement.
Bogle also addresses one of the biggest objections people have to index fund investing. But what if I can find a really good active fund manager? His response is brilliant and backed by decades of data. Even if you could identify a fund manager who will beat the market in the future, which is nearly impossible to do, you'd have to overcome several major obstacles. First, good performance in the past doesn't predict good performance in the future. The fund managers who were stars 10 years ago are often laggards today, and vice versa. Second, even if a manager does beat the market, they usually don't beat it by enough to overcome their higher fees. Third, successful fund managers often see so much money flow into their funds that they can no longer implement the strategies that made them successful in the first place. But here's the kicker. Even if you could somehow identify the few fund managers who will consistently beat the market after fees, you'd have to stick with them during the inevitable periods when they underperform. And human nature being what it is, most investors abandon good strategies right before they start working again. I learned this lesson the hard way when I was in college. I found a mutual fund that had been beating the market for 5 straight years, and I put a big chunk of my savings into it. For the next 2 years, it underperformed badly while the overall market was doing great. I felt stupid for not just buying an index fund, so I sold the actively managed fund and switched to indexing. Of course, right after I sold, the active fund started beating the market again. I had perfectly timed my decision to maximize my losses and minimize my gains. This is exactly the kind of behavior that Bogle warns against. He shows that the average investor in actively managed funds earns significantly less than the funds themselves because they're constantly chasing performance and switching between funds at exactly the wrong times. The beauty of index fund investing is that it removes all of these psychological traps. You can't second-guess your decision to own the entire market because there's no alternative that makes sense. You can't time your purchases poorly because you're making them systematically regardless of market conditions. You can't chase performance because you're not trying to beat anything. You're just trying to capture your fair share of whatever the market provides. Bogle goes deep into the mathematics of compounding, and this is where index fund investing really shines. Small differences in fees and returns compound dramatically over time. A 1% difference in annual returns might not seem like much, but over 30 or 40 years, it can easily double or triple your final wealth. He gives an example that really stuck with me. Imagine 2 investors who each contribute $5,000 per year for 40 years. One pays 2% annually in fees and earns 8.8% per year after fees. The other pays 0.2% annually in fees and earns 9.8% per year after fees. After 40 years, the low-cost investor has almost twice as much money, even though the difference in fees was only 1.8% per year. This isn't theoretical. This is exactly what happens when you compare the long-term performance of low-cost index funds to high-cost actively managed funds. The math is relentless and unforgiving. High fees are a virtually guaranteed way to reduce your investment returns, and there is no evidence that higher fees lead to better performance. What really impressed me about Bogle is that he doesn't just focus on the financial benefits of index investing, he also talks about the lifestyle benefits. When you embrace his approach, investing becomes incredibly simple and stress-free. You're not constantly wondering if you've made the right choices. You're not losing sleep over market volatility, and you're not spending your weekends researching investments. Instead, you can focus your time and energy on the things that actually matter: your career, your family, your health, and your personal interests. Your investments just quietly compound in the background while you live your life. This resonates with me so much because I remember how much mental energy I used to waste on investment decisions. I would spend hours reading about different funds, analyzing performance charts, and trying to optimize my portfolio allocation. All of that time and stress for returns that were worse than what I could have achieved by just buying one simple index fund. Bogle also addresses the common concern about market crashes and bear markets. Yes, if you own the entire stock market through an index fund, you'll lose money when the market goes down. But here's the thing, you'll also participate fully in the recovery. And historically, the market has always recovered from crashes and gone on to reach new highs. The investors who get hurt in market crashes are usually the ones who panic and sell near the bottom, or the ones who are taking excessive risks with leveraged investments or speculative stocks. Index fund investors who stay the course during market downturns have always been rewarded for their patience. I think about the investors who stayed calm during the 2008 financial crisis. Yes, their portfolios lost about 50% of their value at the worst point. But if they kept contributing to their index funds throughout the crisis, those purchases at depressed prices generated enormous returns as the market recovered. The people who panicked and sold in 2008 and 2009 locked in their losses and missed the subsequent recovery. One of Bogle's most important insights is about the difference between the investment business and the investment industry. The business of investing is about allocating capital efficiently to help companies grow and create value. The industry of investing is about generating fees and profits for financial intermediaries. These two things are often at odds with each other. What's good for the investment industry, high fees, frequent trading, complex products, is usually bad for investors. What's good for investors, low costs, simple strategies, and long-term thinking, is usually bad for the investment industry's profits. Bogle spent his career fighting against the industry on behalf of investors, and he paid a price for it. He was often criticized by his peers for destroying the mutual fund industry by offering low-cost index funds. But from an investor's perspective, he was simply offering a fair deal in an industry built on taking advantage of people's lack of knowledge. This connects to a broader theme in Bogle's work about the importance of putting investors first. He argues that too much of the financial services industry is focused on enriching intermediaries rather than serving the people who provide the capital. This misalignment of interests is one of the main reasons why active management fails to deliver value for investors. Another key concept from the book is Bogle's emphasis on asset allocation, specifically the split between stocks and bonds in your portfolio. He doesn't get too complicated with this, but he does provide some simple guidelines based on your age and risk tolerance.
For young investors with decades until retirement, Bogle suggests having a high allocation to stocks, maybe 80 to 90%, with the remainder in bonds. As you get older and closer to retirement, you gradually shift toward a more conservative allocation with more bonds and fewer stocks. The beauty of this approach is that you can implement it with just two index funds, a total stock market index fund and a total bond market index fund. No need for complicated strategies involving small-cap value stocks, emerging markets, real estate investment trusts, or any of the other asset classes that financial advisors love to talk about. I remember when I first simplified my portfolio down to just these two index funds, I felt like I was somehow cheating or being lazy. I had been conditioned to think that successful investing required dozens of different holdings and constant rebalancing between sectors and regions. But the more I learned about Bogle's research, the more I realized that simplicity is actually a feature, not a bug. Complex portfolios don't necessarily deliver better returns, but they do deliver higher costs, more opportunities to make mistakes, and more time spent on maintenance. Sometimes the best thing you can do is just get out of your own way and let the market do what it does. Bogle talks a lot about the power of time and patience in building wealth. He shows that while the stock market is incredibly volatile in the short term, it can easily be up or down 20 or 30% in any given year. It becomes much more predictable over longer periods. Over rolling 10-year periods, the stock market has delivered positive returns about 95% of the time. Over rolling 20-year periods, it's been positive virtually 100% of the time. This is why Bogle emphasizes that index fund investing is a long-term strategy that requires patience and discipline. The hardest part isn't picking the right funds or timing your purchases. It's staying committed to the strategy when everyone around you is panicking or getting greedy. During bull markets, you'll be tempted to take more risk to chase higher returns. During bear markets, you'll be tempted to abandon the strategy entirely to avoid further losses. This is where having a clear understanding of the principles behind index investing becomes crucial. When you truly understand why the strategy works and what the historical data shows, it becomes much easier to stick with it during difficult periods. One aspect of Bogle's approach that I find particularly relevant for young Americans is his emphasis on starting early and investing consistently. He shows that time is more powerful than any other factor in building wealth. Someone who starts investing at age 25 doesn't need to save nearly as much as someone who starts at age 35 to end up with the same amount of money at retirement. This is because of the magic of compound growth. When you invest early, you're not just earning returns on the money you contribute, you're earning returns on all the previous returns you've accumulated. Over time, this compounding effect becomes incredibly powerful. But here's what's tragic. Most Americans don't start investing seriously until they're in their 30s or 40s, and by then they've missed out on some of the most valuable years of compounding. Student loans, housing costs, and other expenses certainly make it challenging to invest when you're young, but even small amounts invested consistently can make a huge difference over time.
Bogle also addresses some of the common myths and misconceptions about index investing. One criticism you often hear is that index funds are average, and that by definition, they can't beat the market. This misses the point entirely. Index funds don't beat the market, they are the market, minus a tiny fee. And average market returns have been pretty spectacular over time. Another criticism is that index funds contribute to market inefficiency because they don't analyze companies or allocate capital based on fundamentals. Bogle's response is that as long as even a small percentage of investors are actively researching and trading stocks, the market will remain reasonably efficient. Index fund investors are simply free riding on the research done by active investors, which is perfectly legitimate and economically efficient. Some people also worry that if everyone indexed, the market would become inefficient because no one would be analyzing companies and setting prices. But this is a theoretical concern that's nowhere close to becoming a practical problem. The vast majority of institutional money is still actively managed, and there will always be traders and speculators trying to find mispriced securities. As we wrap up our discussion of Bogle's wisdom, I want to emphasize the most important takeaways that can transform your approach to building wealth. First, keep it simple. You don't need dozens of different investments, complex strategies, or sophisticated analysis to be a successful investor. A broad-based stock index fund is all you need to capture your fair share of the wealth created by American businesses. Second, keep costs low. Every dollar you pay in fees is a dollar that can't compound and grow over time. Small differences in costs lead to huge differences in wealth over the long term. Always compare expense ratios and choose the lowest cost option that meets your needs. Third, be patient and stay the course. The stock market will be volatile, and there will be periods when your investments lose value. This is normal and temporary. Don't let short-term volatility derail your long-term plans. Fourth, start early and invest consistently. Time is your most powerful ally in building wealth. Even small amounts invested regularly can grow into substantial sums over decades. Don't wait for the perfect time to start. The perfect time was yesterday, and the second best time is today. Fifth, ignore the noise. The financial media, investment industry, and even well-meaning friends will constantly try to convince you that you need to do something more complicated or exciting with your money. Resist this temptation. Boring beats exciting when it comes to long-term wealth building. Finally, remember that successful investing is more about avoiding mistakes than it is about making brilliant moves. By keeping things simple and sticking to proven principles, you'll avoid most of the costly errors that destroy wealth over time. The Little Book of Common Sense Investing isn't just about index funds. It's about having the wisdom to recognize that sometimes the simplest solution is also the best solution. In a world that profits from making things complicated, Bogle's message of simplicity and common sense is revolutionary. John Bogle spent his entire career fighting for ordinary investors against an industry that was designed to enrich itself at their expense. His legacy is that millions of Americans now have access to low-cost, effective investment options that didn't exist before he came along. But the most beautiful part of his story is that you don't need to understand anything about finance or economics to benefit from his insights. You just need the wisdom to recognize a good deal when you see one, and the discipline to stick with it over time. So there you have it, friends, a simple path to wealth that requires no special knowledge, no complex analysis, and no ability to predict the future. Just buy the market, keep costs low, and let time do the rest. Your future self will thank you for choosing the path of common sense over the path of complexity.